Hi guys, welcome back to my YouTube channel. At this video, I want to share you about capital budgeting. This is that I learned at the second week in course of corporate finance at IPMI International Business School by Professor Sembel. At the beginning of capital budgeting, we have a mini case. We call entrepreneur SPBG. Mr. Elmo is thinking of becoming an entrepreneur in gas station business. He has collected some information regarding the business. Initial investment 2 billion rupiah. Initial net working capital 100 million. Revenue per year 700 million. Maintenance cost per year 150 million. Economic age of SPBG 5 years. And terminal value after 5 years 1,250 million. Tax rate 25% and K 10%. We must verify feasibility of the investment. We must make some sensitivity analysis, such as level of K that makes the investment not feasible, level of IO that makes the investment not feasible. Third, level of revenue that makes the investment not feasible. Fourth, level of cost that makes the investment not feasible. And the last, level of TCF that makes the investment not feasible. So, we have 5 questions that we must solve based on the formula that we create to solve this kind of issue. So, before we go to the calculation of this mini case, we have a capital budgeting decision criteria. Capital budgeting is a planning process for investment in long-term asset. For example, that kind of mini case. Will that investment give added value? And how much is the return and the risk? It's like a two important question that we always come to us when we want to make ourselves like an entrepreneur, or when we want to run some business, right? So actually, decision-making criteria in capital budgeting is talk about want to accept or reject a long-term investment proposal. So in the capital budgeting concept, we must make some estimate expected future cash flow, evaluate the project based on capital budgeting evaluation criteria, and then decide whether which project is good or bad. 2 or more projects can be 1 mutually exclusive, may choose only one, or independent, may choose all good projects. Now, I have 2 simple case. For example, mutually exclusive project. If you have one piece of land, you want to build mall or factory. In capital budget concept, have some formula or terminology. First, initial cash outlay that we call IO. For example, you have 10 million. Second, you must know the formula of periodic cash flow that we call CFO. CFO. It means minus 10 million. And the last, thermal cash flow. Cash flow at the end of the project can be positive or negative. So at the beginning, we have an initial cash outlay. During period we run the business, we call periodic cash flow. At the end of the project, we call terminal cash flow. I want to share you the first capital budgeting method that we call payback period. The important question in payback period is how many years does it take to cover the initial investment? Okay guys, after you calculate it by using payback period, finally we found some weakness from this method. First, subjective. Second, not consider time value of money. Third, not consider required rate of return. And fourth, not consider all cash flow from the project. So, corporate finance proposes another method. Second, we can calculate it based on net present value, or we call NPV. Third method, we can use profitability index or PI. Third, we can use internal rate of return, we call IRR. All three methods above consider all cash flow, time value of money, and required rate of return. So guys, I want to share our capital budgeting method that we call net present value. Net present value, calculating present value of all cash flow, positive or negative. The formula is NPV equal present value cash flow negative investment outlay. So, net present value based on project A or project B. Project A, build mall. Project B, build factory. Time just only 4 years. After you calculating using this formula, you will get 11,095 minus 10,000 equal with 1,095 dollar. So NPV decision rules have accept if the NPV equal more than 0. It means build mall or factory accepted. You can build both of them or one of them based on NPV analysis. After you put all numbers figure at or in that formula, you will get PA for A. You will find 1,095. Okay, after you put all numbers and figure in that formula of PI, you will find PA for A 1.1095 and PA for B you will get 1.1154. What does it mean? In PA or in profitability index, you have decision rule. Accept if PI equal more than 1 and reject if PA lower than 1. Now we calculating using capital budgeting method 4. We call IRR, internal rate of return. IRR, return of the invested capital on investment for a capital project. how it's work on formula. It's quite little bit confused. I will show you this. So IRR equal with K that makes present value of cash inflow equal to cash outflow or investment outlay. Basically, the calculation of IRR is the discount rate that makes NPV equal with 0. So, decision rule of IRR, if IRR equal or more than required rate of return, you must accept. But if IRR below than required rate of return, you must reject it. So guys, after I learned about different method, start from payback period, NPV, profitable index, until IRR, we must put all of the analysis result together in one table. We can compare payback project A or project B. Based on the result, we will choose A. How about another capital budgeting method? NPV. Project A, we already get $1,000. Project B also. But project B will get more higher than A. So we choose B. IRR. Based on IRR, project A get 14.96% and project B we get 30.50%. So we choose A, higher than B. How about the profitability index, PI? Project A will get 1.1095. Project B we get 1.1164. So we choose B because higher than A. So you get more complete analysis data which help you to choose which one project that you will give you more profit. This is the beauty of capital budgeting method that we use in corporate finance by IPMI International Business School, lecturing by Professor Sembel. So, comparison of method, time value of money payback does not adjust for timing differences. NPV, IRR, and PI take into account the time value of money. Relevant cash flow? Of course, NPV, IRR, and PI use all cash flow. Payback method ignores cash flow that occurred after the payback period. So, you cannot use one method to make a decision. You must use all of the method in the capital budgeting.